So, the government just made a massive $200 billion move in the housing market, and wow, has it sparked a debate. The big question we're going to tackle in this explainer is pretty simple. Is this a once-in-a-lifetime opportunity for homebuyers, or is it a carefully laid trap?
And this is the number that kicked it all off, 5.98%. For the first time in what feels like forever, almost 4 years, the average 30-year fixed mortgage rate has dropped below that huge psychological barrier of 6%. For millions of people who've been sitting on the sidelines, this was the magic number they were told might never come back.
But here's the thing. This wasn't some natural market shift. This rate drop was triggered by a massive action from the government. So what's the real story here? Are we looking at a genuine sale on the American dream, or is this whole thing just a trap designed to prop up the market at the buyer's expense?
To figure that out, we've got to understand where this rate even came from. Let's follow the money.
And the source is a $200 billion executive intervention. The government literally directed the two mortgage giants, Fannie Mae and Freddie Mac, to wade into the private market and just start buying up mortgage-backed securities. The goal? To deliberately and forcefully push interest rates down.
So, why on earth would they do this? Let's break down the official reasoning, what we might call the strategist's viewpoint. The core idea is to unfreeze a housing market that has been completely stuck in place for years.
And to get how they did it, it all comes down to this thing called a mortgage-backed security, or MBS. See, when you get a loan, your bank usually doesn't just hold on to it. They bundle it up with thousands of other loans into an MBS and then sell that to investors. And the price of these MBS, well, that directly impacts the mortgage rate that you end up getting. Now, what's really fascinating here is just how simple the mechanism is. So, step 1, the government becomes this giant buyer of these mortgage bonds. Step 2, all that new demand, naturally, pushes the price of the bonds way up. Step 3, and here is the absolute key, when a bond's price goes up, its yield, its rate of return, goes down. And then step 4, those yields are exactly what your lender uses to set your mortgage rate. So that 5.98% you saw, it wasn't market magic, it was manufactured.
And this brings us right to the problem they were trying to solve, mortgage lock-in. Just think about it for a second. If you've got a 3% mortgage from a few years back, are you really going to sell your house just to buy a new one at a 7.5% rate? No way. Of course not. You'd stay put. Millions and millions of people made that same logical choice, and it completely froze the supply of homes for sale. This intervention is designed to break that lock.
But, not everyone sees this as a brilliant solution. There's a whole other way to look at this entire operation. This is the critical view, the financial journalist's perspective, which basically argues this isn't help at all, it's a trap.
And this slide just lays out the two sides of the coin perfectly. The strategist sees this as a sale. It breaks the lock-in, gets the market moving again, and it gives buyers about $30,000 more in purchasing power. But the journalist? They see a trap. They argue this intervention creates an artificial floor under prices, preventing them from falling like they naturally should, and worse, by juicing up demand without actually fixing supply, you could cause prices to literally explode upward.
This quote from the source material just crystallizes the critical argument perfectly. The government is lowering the cost of borrowing to prevent the cost of the house from falling. It's relief for the seller, but a trap for the buyer. Just let that sink in. It means the government is making your loan cheaper specifically so the price of the house itself doesn't have to come down. It's a move that helps sellers maintain these super high prices, potentially trapping buyers at the very top of the market. Now, as if all that wasn't complicated enough, the government did something else at the exact same time. They threw a major wild card into the mix by going after big institutional investors.
On the surface, the logic here seems pretty sound, right? Stop these giant corporations from swooping in and snatching up all the starter homes, leaving more for regular families. But there's a counter logic here, and it's a powerful one. Those very same firms also finance a ton of new construction. So what happens if you ban them? Well, you risk cutting off a major source of new housing supply at the exact same moment you're pumping up buyer demand with lower rates. That combination is a textbook recipe for a price explosion.
And on top of all of these internal market dynamics, you've got these massive external risks lurking out there on the horizon, black swans, that could completely derail this entire plan. So the first big risk is a potential war in Iran. The source points out that just the uncertainty has already pushed oil up to $75 a barrel. If that keeps going, it could totally reignite inflation. That would force the Federal Reserve to start hiking interest rates again, which would completely erase this 5.98% gift literally overnight. The second risk is something called the Genius Act.
It's new legislation that encourages people to move their savings out of traditional banks and into new digital assets. If that happens on a huge scale, well, the banks won't have enough money to fund mortgages. And if private investors don't step in to fill that gap when the government eventually steps out, rates could snap right back to 7% or even higher.
Okay, so given all of this fragility and all this intervention, how should you be thinking about this? What's the actual takeaway for your own housing strategy?
All right, here are the key takeaways from the source. First, you have to see this sub 6% window for what it is, a very fragile, temporary gift that's being funded by the government. Second, stop waiting for 3% rates to come back. In this new world, 6% is the new low. Third, you've got to keep a close eye on the 10-year Treasury yield. If you see that thing climb back above 4.2%, that's your warning signal that these low mortgage rates are about to vanish. And finally, and this is so crucial, you have to recognize that with this much government involvement, housing is just not the risk-free asset it used to be. The game has changed.
So where does all this leave us? The source puts it like this. The American dream isn't dead, but in 2026, it's being kept on life support by a $200 billion IV drip. And that just forces us to ask, is a dream that needs this much intervention really healthy? And maybe more importantly, what happens to all of us when that IV drip runs out?